sources, including multilateral sources.
All right, so you could see the confidence where we went to the market and we got an oversubscription, okay? And this is very common looking at our trend in the local market because we've been listing infrastructure bonds. The most recent one was the government was looking for 70 billion. And guess what? There was a subscription of close over 270 billion, if I'm not wrong, thereabout. And the government says we'll pick close to 200 billion shillings. So it's even a wonder why we were not able to take the whole 6, but it is subject to discussion and elaboration, especially from our specialists. So we floated this Eurobond. We are using it to finance. We've taken 1.4. We still have a deficit of close to $600 million. And as you've rightly heard from the PS, he says that that particular gap will be able to finance it through development partners. If you can remember, this governor for the central bank noted the inflows that we've been experiencing in the economy from development partners, and that will be used to bridge that particular gap. But even as we talk about that gap, how do we interpret this? And I'm going to be coming shortly to our analyst in studio, but what is the interpretation of all this? Is it something that should get us worried when we offer a bond and it is at such a costly, it's such a costly affair compared to the previous bond, first of all? Is it something that we should be confident? Is it boosting confidence in the economy? Is it reflective of the confidence? This is the PS still talking about how this is a confidence boost on Kenya from the international investors' perspective.
Confidence boost to us because it shows that the rest of the world now believes Kenya is good for business. And we have been out of the market for a long time. We tried in 2021, we couldn't go. But now the market is open and we are very happy for this.
Now the market is open. We are very happy for this. Question is, at what cost? Now, when you compare the previous payments that we've been paying in the Eurobond that we were supposed to clear by mid this year compared to the new one, Treasury is of the thought that actually it is a better deal, slightly expensive, but not so much money. According to the PS, the difference in regards to what we were paying in this regime and later in the Eurobond that we've just accepted, the new one, it's not such a huge difference. Let's listen as he puts these words by himself.
That we have been paying 21 billion and now we are going to pay 22. So it's just about $1 billion difference that we are going to be paying. It's not a lot, and it is a price to pay for given the situation that we are in, where liquidity is tight, and it is a reflection of where the market is. We think it is better than even the syndication loan that we have taken.
All right, so that is our journey with Malta's Eurobond, okay? Take a loan to repay this loan that is due, and you are not able to do that in time. And question is it the right environment? I want to engage Dr. Tobias. You've listened to Treasury, you've listened to the government, you've seen the way the rates are, the interest in Kenya's Eurobond. I mean, was it the right move by the government to go to the international markets and sort of take a loan to pay for this loan?
Yes, Noah, if you listen to the PS, it's like we had run out of options, and the only option which was left to get the money was to go to the market, because down here we didn't have cash. We were on a cash crunch. You look for money where money is. So probably the step of going to the international market was a good one, particularly the success of Ivory Coast and Benin in the market, and also the fact that market was back. The only challenge, as all of us are observing there, is that this is coming at an expensive rate, which means we are going to tighten our belt further. Of course, from an ordinary situation, if you went to a certain primary school where your sock was torn and you put some patch on it, you again put another patch when it is torn, you know the kind of trend that you're likely to have. So for now, and I'm saying for now, we can actually we can enjoy the reprieve, because as it was headed, having spelled to be, we were likely to be defaulters, but for now, we have been rescued. So there is that rejoicing. You know, when you are cornered and something happens that you get some help, you feel good because you have escaped. But you see, if the danger is still ahead, you still have to think further and sweat further. So as a republic, we still have a lot of weight on our side, particularly on repaying this.
And I mean, when you talk about public debt and borrowing, because as you rightly put, you're borrowing at a more expensive rate, and it is the trend with our Eurobonds. And again, it's the same issue that we were talking about, even in the campaign trail with this government. The promise was we cut down on debt, especially external debt, because of the volatility that is attached to that nature of debt. Now, I know we are cornered, but what stops this from being the same in, come, is it 2032? Because I know it's a 7-year. In fact, I was just, actually it's 2031. Yeah? What stops a similar situation from reoccurring in 2031, where you're able also to borrow? Again, you just continue being in the same debt situation.
It's rethinking, Noah. For us not to fall in the same situation that we have been, we have to rethink on how to work on our economy right now, so that we build the fundamentals, so that even as we have borrowed, the fundamentals become stronger. We expand job opportunities, employment opportunities. We expand our trade. We expand our agriculture to ensure that we are able to feed ourselves. We expand the development indicators, so that come that time, we will be better off. But obviously, if we don't do that, then we will be worse off than what we were. So that is imminent. So just getting the money is not enough. Doing the job of re-strengthening the economy and refocusing to ensure that the indicators are actually up again, that's what will save us.
And somebody will ask, in regards to the opportunities that are there, if at all we are not to fall into this similar hole, what will that take? Because we've seen the government actually go on an aggressive revenue collection strategy, sealing loopholes, trying to widen that net so that it's a little bit bearable. We all carry the burden. But I'm just looking, what will be the go-to if at all we are to make these payments? In fact, just looking at Treasury acknowledgement of this successful pricing of the Eurobond, they noted that this will amortize in 3 equal installments, 2029, 2030, and 2031, resulting in a weighted average of 6 years. The 2031 Eurobonds have been issued at a price of 97, yielding 10.375%. But in regards to how to be able to cater to this issue of repaying, so that we are not in the same boat, are there measures that this government can take to make it easier for them and also for Kenyans?
Yes, there are, but they call for proper action. You know, we must follow up and ensure that they are done. Because when you talk about sealing loopholes in terms of tax leakage, collecting revenue from each and every individual, that is very clear. That's good. We'll raise the revenue base to be able to cater for that. However, that alone cannot work. What can work is that we must ensure that we have engaged our manufacturing so that we have spurred the economy. We are able to get also export, what to export, so that because you see our foreign debt is denominated in dollars. So every time we are focusing on repayment, we must look at what gives us a better place in terms of dollar position. So we must ensure that we curb those situations where we are looking for the areas that can actually lead to more foreign exchange. Okay. That's the best way of dealing with it.
All right. And I want to bring in Churchill Ogutu, an analyst and a gentleman who's been updating us, if you follow on social media, also very passionate about this engagement. Churchill, looking at this particular situation, because the government is essentially borrowing to repay another loan because you are not able to repay it. And it seems like a logical thing to do. Why is it of big concern to the country, this particular move of going back to the international capital markets and raising a Eurobond, the 2031 one?
Thank you, Noah, for having me today. So at a certain point, we are at a point whereby the bond was to be borrowed, was to be financed by one way of a debt. If you think, is it multilateral debt or on the market? We are not going to, we don't have a sinking fund whereby we had accumulated the monies to be able to fund this Eurobond. So we don't have the necessary taxes. So it was just either one form of debt that we are supposed to go and get so that it goes to refinance this Eurobond. So up until last week on Tuesday, our thinking was that they will go to the international, they will now be able to rely on the multilateral lending to be able to finance this particular maturity. But then they surprised us with going to the international market. So as it is, I think the cost implement is a bit minimal. You're looking at an increase of external debt servicing cost of $8.5 million from 2024 all the way to 2030, 2029. That's when before the first amortization kicks in. So that's pretty much the cost that the government has incurred.
Okay, and looking at it, because it's looking at the way the Principal Secretary, PS, talked about it, he says this is a reflection of confidence by the international markets to the Kenyan economy. Now, is it an issue of smelling blood, a shark smelling blood and saying, I can make as much as possible? Or is it actually that there is hope within this bigger picture of the Eurobond?
I mean, there are many factors that come into play when the government goes to the international market. From one side, you find that investors are hungry for yield, those higher returns. So which markets offer the higher returns? We have the emerging markets, we have the frontier markets, pretty much where Kenya lies in. But then again, you remember that these investors, they run multi-billion-dollar portfolios. So what is $1 billion size? So in fact, they're just, is a small drop in terms of their the overall portfolios that they're managing. So yes, in terms of the demand, that it was quite, there's some confidence. You might now look at the nuances around that. It could also be because investors do not want to miss a slice of this particular issuance. So they may just put a big interest, say $100 million, but in essence, they're just looking at $50 million. So there's that element of a bloated demand. So those are some of the nuances that comes into play. But at the end of the day, what is the cost? What is that yield that investors are looking at if they invest into Kenya? So I think those are some of the things that even play a huge role in terms of the final investment decision.
All right, and Churchill, lastly, I think I had asked Professor here in studio in regards to this issue of, the yields you've talked. I mean, investors want to make money at the end of the day, but locally we have to deal with repaying this particular bond that has been listed. So question is, looking at the local economy and seeing the way the government has been interpreting it, saying liquidity is really low, we don't have much money. They have been on a revenue collection and they increased that pace big time, trying to widen the tax net. Are there avenues that can make it a little bit easier for the government sort of to put us in a better position against this particular bond, so that come 2031, it's not a similar issue of being against the wall or between rock and a hard place?
So one of the things that came out clearly with this new Eurobond is the issue about amortization. So what do I mean by amortization? Unlike the bond that is maturing, that is supposed to mature in June 2024, it was at the same time in June 2024. But unlike now, this new bond, rather than having one big maturity, they have faced it. So $1.5 billion is now the overall size that you have taken with the new Eurobond. But because of the amortization, we are starting to repay off from 2029, $500 million, another $500 million in 2030, and the final $500 million in 2031. So that is one of the ways that the governments have, the authorities have come out to at least to reduce that risk that was on investors, because at $2 billion, the risk was that Kenya probably may not be able to raise this money, looking at the tax collections, looking at even what other needs to be funded, and also where the exchange rate was. Remember that when we took this Eurobond initially in 2014, the dollar to the exchange rate was 87.5. Right now, we are looking at something closer to double that exchange rate. So those are some of the dynamics that usually come into play. So unless now the government finds some durable manner of trying to manage the exchange rate risk that is attendant to these Eurobonds, because we get income in Kenya shillings, as you've rightly said, but then we have to meet the obligations, external debt obligations in the currency that is domiciled in, and in this case is in dollars. So there's that exchange rate risk that needs to be managed. So that has to be managed. And also, at least what they have done is now to reduce the big maturity risk that was with the 2024 Eurobond.
All right. We want to take a short break. When you come back, since you've touched the exchange rate risk, we've seen our shilling appreciate against the dollar, and a lot of people are confused. What exactly is going on here? And Dr. Olweni here, he says that he sold his dollars while it was up there at 150, 160. Question is, what is the implication? What is the cost and the implication of this actually steep appreciation against the dollar? Stay tuned. We take a short break now.